The mainstream financial world isn't talking about it, but the people who track historical cycles, the analysts who examine old charts like archaeologists digging through forgotten ruins, they see it. And they're uneasy, because the 18-month crash pattern isn't a prediction. It's a sequence, a rhythm, a set of behaviors the market falls into when pressure under the surface becomes too heavy to hide. Like a bridge that begins to sway before it snaps, the movement itself becomes the warning. To understand where we are right now, you have to understand how this pattern forms. It always begins with phase 1, the surge. The market climbs with confidence, sometimes rational, sometimes completely manufactured. Investors feel invincible, news headlines cheer the gains, and politicians claim credit for the boom. But underneath, something starts whispering that the numbers don't match reality. Debt rises faster than wages. Asset prices disconnect from fundamentals. Companies with no profits soar. Consumers borrow more to maintain the illusion of prosperity. It's the calm before an earthquake. The ground looks steady, but the pressure is building. Then comes phase 2, the distortion. Prices stop rising smoothly and begin moving in strange, jagged waves. Volatility increases. Bond yields start behaving unpredictably. Corporate insiders sell quietly while telling the public everything is fine. Central banks begin using vague language about adjusting policy or managing inflation expectations. This phase always feels confusing because the signals aren't loud, they're subtle, like coded messages hidden in financial data. The market is still up, but the energy changes. People don't realize they've shifted from confidence to denial. And then the pattern enters phase 3, the fracture. This is the moment when the cracks become visible. Layoffs begin quietly. A few large companies report unexpected losses. Small banks start failing. Credit tightens. But instead of hitting the brakes, consumers keep spending, convinced the storm will pass. It always feels eerily calm, as if someone hit the mute button on reality. Historically, this part lasts between 3 and 5 months. And then something triggers the break. It might be a geopolitical event, a bond market spike, a banking scare, or a sudden liquidity crunch. Every crash has its own spark, but the tinderbox looks the same. If that's the sequence, then the big question is, where are we right now? According to the data, the timeline matches. 18 months ago, markets began the exact surge the pattern predicts. The run-up was rapid, emotional, and disconnected from actual economic conditions. Then, about halfway through, the distortions appeared: wild market swings, declining savings rates, debt spikes, strange movements in treasury yields, and a surge in insider selling across multiple sectors. And now, many analysts quietly admit we've entered the fracture phase. Layoffs are rising, corporate bankruptcies have increased, banks are tightening lending, consumers are relying more on credit cards than income. The pattern isn't forming. The pattern has formed. Now here's where a little bit of conspiracy slips in. Not the wild kind, but the quiet, institutional kind. Each time this pattern has appeared, those in power recognized it before the public did. Before the Great Depression, the financial elite withdrew capital months before the crash. Before the dot-com bust, insiders dumped shares while urging the public to keep buying. Before 2008, major banks quietly moved toxic assets off their books while telling the world everything was stable. And before the COVID crash, there were unusual financial movements, large transfers, accelerated stock sales, sudden shifts in bond positions that suggested some people knew turbulence was coming. So if the pattern is repeating now, the real question isn't just, are we in it? It's who already knows. Another eerie detail. The 18-month cycle sometimes aligns with credit conditions more than stock prices. When liquidity dries up, markets follow like dominoes. And right now, liquidity is shrinking. Banks are pulling back. Government borrowing is exploding. Interest payments are consuming a massive share of tax revenue. And the bond market, historically the true predictor of crashes, is flashing warning signs that look almost identical to its behavior before 2008 and before the 1987 crash. Yet every major institution keeps telling the public the same thing. Everything is fine. No need to worry. That's exactly what they always say right before the seismic shift. The pattern isn't magic. It's psychological. Humans react the same way to financial stress now as they did in the 1920 seconds. Optimism, denial, confusion, fracture, collapse. The cycle repeats because we repeat. Markets aren't rational, they're emotional. They're crowds, not calculators. And when crowds break down, they break down the same way every time. That's why the 18-month timeline keeps returning. It's not about math. It's about human behavior. So what happens after phase 3? Historically, phase 4 hits fast. The cascade. This is when markets drop sharply. Bond yields spike. Housing cools. Investors panic. Headlines turn negative overnight. The people who once said, "This time is different," suddenly pretend they saw the crash coming. Regulators scramble. Politicians blame each other. And the cycle completes itself. But here's the part that should concern everyone. Every time this pattern has appeared, the final drop was always sharper than expected. The 1929 crash took years to recover from. The dot-com crash wiped out entire industries. The 2008 collapse triggered a global recession. Even the COVID crash, though brief, was historically violent. The cascade phase is never gentle. Now, does that mean a crash is guaranteed? No. But historically, the pattern has an almost perfect record. When the timeline completes itself, something breaks. Sometimes it's the stock market. Sometimes it's the bond market. Sometimes it's the banking system. Sometimes it's the currency. But something always gives. And the eerie truth is, we're close to the end of the pattern right now. Some financial historians believe this entire sequence is tied to a deeper structural cycle, a repeating 18 to 20-month behavioral wave that institutions don't talk about publicly because acknowledging it would spark panic. Others argue the cycle is too consistent to be coincidence and suspect that large players, governments, major funds, multinational banks strategically move before the public, making the pattern look predictive when it's actually orchestrated. That doesn't mean the market is rigged in a cartoonish way, but rather that the people with the most data move first. And when they move, the rest of the market eventually follows. So here's where we actually are now, in the late stages of the fracture phase. Not the beginning, not the middle. The late stages, the part where the pattern narrows. The part where pressure builds quietly. The part where nothing seems wrong on the surface, but everything is shifting underneath. Historically, this window right where we're standing comes just before the cascade. And that leads to a final uncomfortable question. If this pattern has repeated for nearly a century, if its signals are visible right now, and if major institutions always seem prepared before the public, then what does that say about the system itself? Is the pattern simply an organic cycle of human behavior? Or is it a rhythm the market has been conditioned to follow, a cycle the largest players use to transfer risk downward, off their books and onto the public every decade or so? History leans toward the second explanation more than most people want to admit. So as we stand here, looking at the charts, watching the signals, recognizing the same movements that preceded every major market downturn of the modern era, one truth becomes impossible to ignore. The 18-month crash pattern isn't a myth, it's a mirror. And right now, it's reflecting something we've seen many times before. Where we go next depends on whether the pattern breaks or whether the market does.